Hey, today we got a special treat for you. I was recently able to sit down with our preferred lender and talk about various mortgage related things, but most importantly, the complete overhaul that the state of California did for the first time home buyers program. It really opened it up to a lot more buyers than used to be qualified for the program, and I think you're guaranteed to learn something that you didn't know before. Stay tuned. I think you'll like it. What up, AJ?
What up, JC? Thanks for having me, man.
Have you ever had a fancy mic in your face?
No, first time recording, podcasting, all that. So excited.
Right on, dude.
Let's do it.
We're gonna talk some real estate, some mortgage today.
Let's do it.
Been doing this long enough to be able to probably field most of these questions.
Sure. Yeah. Try my best.
Yeah, help folks out. So, all right. So much talk about rates right now.
Mhm.
Everyone's up in arms. They were flipping out the last few years because they were so low, and then they're just no way it is anything that's currently being offered acceptable to people right now.
Right.
And we're like, okay, put a little bit of a historical context on it for us. Like where are we now in late March of 2023?
Yeah.
And like where does that fall in, I don't know, your lifetime, my lifetime, my parents' lifetime? Like not that long. I'm going to go back forever, but just like recent history.
Sure. So yeah, rates have been on the increase, on the climb over the last year or so. I got into the mortgage business in 2016. I think rates at that time were like in the five zone. So we're a little bit above that right now. We're sitting at, in the low sixes, depending on the scenario. Obviously, there's so many different factors that come into play that is going to determine somebody's interest rate. If we look at like a long, expansive timeline, if we go back to the 70s, the average over, those 40, 50 years, average rates are like 7.5 to 8. So if we look at that context, we're below average right now. The good thing is there's a lot of innovation that happens when we get these rate environment changes. So there's a lot of cool programs right now that can help people ease into their rates, into their payments, to make that a little bit more affordable.
Can you talk a bit about that? Like what kind of programs are you talking about? I'm sure you got little piqued interest.
Yes. Yeah, totally. So the main thing that we're seeing right now is it's called a temporary buy down. So there's a couple different ways to structure that. So basically how it works, the most common one that we see, it's called a 2-1 buy down. And it's something that the seller pays for. So it allows buyers right now to kind of take advantage of the softer market that we be in. With rates being higher, obviously that impacts affordability. So you have a lot of buyers that aren't in the market right now. It's obviously going to be case by case scenario. Some listings are sitting longer. So if we can take advantage of that, getting some seller credits to pay for this temporary buy down, going back to the most common one, the 2-1. So essentially how it works is in the first year, the interest rate is 2% lower than your original note rate, start rate, that rate that you qualify for. In year 2, it's 1% lower, and then it'll pick up to that original rate in year 3. The cool thing is if and when rates do come back down, a buyer who's in that scenario, they can take advantage of a refinance, and any additional funds that were kind of set aside to pay for that buy down, they get to keep that. So that's pretty cool. It'll go towards their principal balance. So it's not like they're losing those funds should they refinance before that rate picks up to that original start rate.
Interesting. Cool. Yeah. So you're buying yourself some time,
right?
I guess with the hopes that you're going to be able to refinance inside that window.
Correct. Yeah.
And make something that you have for a short period of time more permanent.
Correct.
Is that about right?
Yep.
Gotcha.
That's the idea.
So it seems to me like a little bit of a safer version of the old ARMs that used to be popular.
Right.
Back in the day, people could get a loan that wasn't fixed for 30 years at all. It was fixed for 1 year, 3 years, 5 years, 7 years, 10 years, depending on what sort of rate you were looking for. And then it would have a 30-year amortization, but it was only fixed for that period of time, and then it would become an adjustable rate mortgage.
Right.
Like that seemed to be the way most people got around rates that they weren't wild about a decade or two ago.
Right.
Are those popular, or are they just not really good options for people right now?
So there's going to be, some scenarios where you might have like regional banks for a short period of time pop up, and then they'll be able to offer like smoke and arm rates. In general, what we're seeing is that that type of product is just kind of getting away. Even those like regional banks, smaller credit unions, it might be like a 6 month window where you can have access to an arm that might be 2% lower than, current market rate. I'm a mortgage broker, so we have access to, we have like 40 different investors that we work with.
Mm-hmm.
And so when we're pricing things out, at least in the wholesale space, um, most often the 30-year fix is going to be a better interest rate in terms of pricing. Usually, you're paying a bunch of points up front for some of these ARM products. So we just kind of see the industry getting away from the ARMs. We see these, temporary buy downs.
Yeah.
A lot of people are, even permanent buy downs on a 30-year fixed, being able to take advantage of the seller credits to do that as well. Especially if it's like a long term, somebody's buying their primary residence. It's like the dream home. They're gonna, be in it for, 10 plus years. These permanent buy downs can, make sense.
Permanent buy down as
Permanent
opposed
buy.
to a temporary buy down.
Correct. Yeah.
So not as inexpensive, right?
So,
But
well, a permanent buy down is going to be more expensive. Like your, ROI or your bang for your buck on a temporary buy down. It's going to be a lot cheaper to buy it down 1 or 2% than the permanent.
right.
But for those scenarios where maybe you're in a multiple offer situation, and seller credits are just kind of out of the question in that scenario. A lot of people are going for the permanent buy downs on something that's going to be long term. If it's like, hey, if it's an investment property or something that isn't going to be held for long term, that ROI on a permanent buy down usually doesn't make sense. But obviously, that's kind of the world that we live in real estate. Is every scenario is going to be different. You're going to want to
Course.
review all options.
Yeah. So for the permanent buy down, anybody can pay for that. But for a temporary buy down, it needs to be seller paid. Is that the case?
Correct. Yep. Seller paid.
And to my understanding, the cool thing about temporary buy downs are that if you do end up refinancing inside that window that it is bought down, you get refunded.
Yeah. So how you think about it is, let's say it takes $15,000 in seller credit to get your 2-1 buy down. So those funds are going to sit in, let's think about it like an escrow account. It's going to sit in an account, and it's going to subsidize your monthly payment for those first 2 years. If you refinance after year one, right? Let's just make it simple. Your anniversary on year one, you refinance, you're going to have that remaining year left in that escrow account. And so that will go directly towards your principal. So when you do that refinance, so you can't like cash it out or like hang.
So you don't get a check.
You don't get a check. You can't go on a
Okay.
vacation or
Yeah.
buy whatever it is, shopping spree. But you still, those funds are yours. It was negotiated. They're your funds. They were meant for this subsidy on your monthly payment. But you refinance, so it'll just go to buying down your principal, which is
Got it.
pretty badass.
Okay.
That you get to keep it.
Good to clarify that. Okay. For people who've never been through the process before, what is the typical timeline for the mortgage application process, the pre-approval, the conditional approval? What can borrowers expect, and how can they speed the process up if they're like, hey, I want to take advantage of this dip in rates, or I saw this house that I'm really stoked on, what can they do to speed the process up faster than on a normal process?
Yeah, that's great. That's great. So, lots of different questions in that bucket right there. I would say the application process it depends on where you go. With us, we have a 24-hour turnaround time. So, from the time that you submitted your loan application and got all of your documents together, within 24 hours, we'll have all of your options researched, and we'll be reaching out to schedule. We call it a mortgage planning session. We like to, our approach is collaborative, learn about your goals, what you're trying to do. We do the research. Hey, here's what we think are going to be the best 2 to 3 options. So within, 24 hours, you'll have your pre-approval set. In most cases, those pre-approval letters will be good for 90 days. So you kind of have that 90-day window to go out and look for that property. And then kind of the next portion would be, hey, you found the property. You're working with a great realtor, negotiator. They got you in escrow. We open up escrow. In most cases, right now we're seeing a lot of people say like 30 days. I think in most cases, and you could probably, speak to this, 21 days or less is kind of, the preferred. Obviously, there's going to be those, certain scenarios where you need a longer escrow, et cetera. Most cases, 21 days. So through that process, we've done a lot of the legwork upfront with the pre-approval. We have all of your, income, asset statements. If you own other properties, we got all of that stuff dialed in. Getting into opening up escrow. So the next portion would be submitting to the actual underwriters. Turnaround times on those to get what you mentioned, it's called conditional loan approval. So we'll submit everything. You get like your title, your title reports, your prelim, all of the income asset documents. Within 2 days, all of that stuff is reviewed. The underwriters will give us conditional approval. So they've given us the thumbs up until this point, everything that we've submitted. Approval conditioned on, usually it's like we're still waiting on the appraisal at that point. We're within the first week of that escrow, waiting on the appraisal. Maybe we got to, button up some of the asset statements, et cetera. Homeowners insurance. Once we get everything, all of those conditions back, we submit for what's called final loan approval. And then we get what's called in our industry clear to close. That's like the sigh of relief. We love making that call. Hey, your loan, we're clear to close, and then we'll get to the loan doc portion, get loan doc signed, and then go through usually final inspections, get your keys, and now you're a homeowner.
Yeah. So for the uninitiated, we've now heard of 3 different bits of the approval: the pre-approval, the conditional approval, final approval. And we're still not done yet, because then we need to be clear to close.
Clear to close, yeah.
People have no idea how much is involved in this process. So I guess the basic rule of thumb is play hot potato with your loan officer, right?
Yeah.
As soon as they ask for something, kick it back so it's not burning your hands it's back in their hands.
Good.
That's what I've always told people.
Yep. Yeah, I like that. Yeah, it's an involved process, and we do as much as we can to mitigate. And even when everything goes perfectly well, like this is a huge life decision, transition, adjustment, especially if it's your first time. A lot of emotions going into it. You're moving out of a place, moving in. So even when everything goes perfectly well, it's still a little bit stressful. So we try to mitigate as much as that as possible. But basically, when it comes down to, there are certain guidelines and regulations and things that we have to get dialed in. I've definitely had my share of battling underwriters, because sometimes there's some overreach, or some things are just like subject to opinion, and when appropriate, when necessary, we'll fight those battles. But in general, it's just, hey, this is the request, let's get it in, let's get it submitted so we can fast track that.
Yeah. Gosh, the old underwriter battle.
Yeah. We love them, especially when we win them. It's just like, me and my processing manager all the time. It's like, is this one that we want to go after? Is it worth it? It's like, yeah, it is. And then we get our victory, and we're celebrating.
You're fighting for the client.
Yeah, we love that.
That's awesome.
Yep.
That's awesome. Okay. What about folks who maybe don't have the best credit in the world? What can they do to help better either prepare themselves for the future or improve their current situation in the midst of a pre-approval process?
Yeah, that's great. If you're inside a year of wanting to purchase, it's always better to start the conversation with your loan officer as early as possible. That way, if they're doing things right, they're going to review that credit profile. And that's, something just standard, like, hey, let's review the credit profile. Are there any tweaks that we can recommend that are going to be cost effective, or that are going to have a high return on money spent? Whether that's looking at, if you have like high revolving credit card balances, that's typically what we see impacting credit scores the most, is people just maxing out credit cards and different things. So if we
more so than missed payments or something like that.
Definitely.
Really?
Yeah. We see that, missed payments, and obviously those big events, people have bankruptcy and different things, and that's a whole set of different challenges to overcome. But if it's that's generally what we see is maxed out revolving credit cards. So if somebody was planning on, coming in with a large down payment, maybe we restructure some of those funds to pay off some debt, which is going to help us on our interest rate more so than, a down payment. Because right now, with where rates are at, for every like 10,000 bucks that you put down towards down payment is only like 65 bucks in monthly payment. So, maybe we work on getting credit scores up to improve the interest rate, or we got some installment loans that carry a high monthly payment. So it's $20,000 left on this car note, but it's a $500 a month payment, so we pay that off instead of that down. So there's just like different tweaks that we can take a look at, make some recommendations to just improve your total profile. And sometimes there isn't much. A lot of people have this kind of idea of like, oh, I need this like perfect credit, or I need the 20% down payment, and then that just prevents them from even starting the process. So there's a lot of people who they're not as good as well off as what they thought, but they can still get an approval on something that makes sense for them, and then they can move forward now.
Right. So it's truly a global approach. You're looking at
Yeah,
all bits of their income
correct.
and
Yeah,
not just saying, how can we maybe lower your loan amount, but if we can affect that rate through paying certain debts off here, that will give you better scores here. Overall, everything is going to cost you less when everything is said and done,
correct.
which is
Yeah,
a complicated puzzle that you
right.
have to play
Yep.
with, I guess, right?
Yep. Yeah, it's complicated, and the puzzle is different every single time.
Yeah.
Every single time. So that's what keeps it interesting. That's one of the parts that we like about this job is it's never the same. It's always new challenges, but it's fun getting in there and getting creative and seeing what we can do to overall. Our goal is have a good experience, but also make sure that you're getting sound advice and you're um, uh, getting a high return on what you have working with as far as your funds to close and everything.
All right, AJ, I know that there has always been a first time buyer program. Some of them are kind of down payment assistance, some of them are credits towards closing costs. I also know that most of my clients have never really been able to qualify for them because if, they usually make too much money. Like there's this tiny window, right, where you have to make enough money to qualify for the loan, but not too much to disqualify yourself for these programs that the government puts together. So, is that all that there is? I heard there's a new one that's supposed to be cooler, better somehow. Like what's going on in this down payment assistance slash first timer world right now?
Yeah, yeah. So in California, there's always grant programs or these different state funded programs that come up. They'll For each year, there's a certain amount of funds that get allocated for them, and then they run out pretty quickly. So the new one, the hot topic right now is through CalHFA. It's a state funded program. They have a new down payment assistance program called the California Dream for All is the name of the program, and it's
The California Dream for
yeah,
All, huh?
yep, the dream, yeah, California Dream,
It
baby.
better be good. It's got a great
Yeah,
name.
yeah. So this one's unique in that it is it's called a shared appreciation program or an equity share.
Okay.
So just kind of the bare bones of the program is um, you can get assistance up to 20% down, which is pretty huge. You use a conventional loan first. And so with that 20% down payment, that gets rid of the need for primary mortgage insurance. Typically, if you're a conventional loan with less than 20% down, you're going to have mortgage insurance. So there's some savings there. Some of the requirements. So there's an income limit, like you mentioned. So it's going to be based by county. San Diego County, that limit is 211,000 households. So if you're,
Hmm.
it's pretty sizable income.
Yeah.
So it's really geared towards like low to moderate income buyers. Some other
But if you
requirements.
got two earners at 100 grand a piece, I
Yeah,
mean, that's that's not so tiny to where most people might not
correct.
fit
Yeah.
into it, right?
Yeah. It's definitely going to open it up,
Right.
the eligibility pool
Sure,
for
that's
that for
good.
sure.
Yeah.
Um, FICO score requirements are 660, debt to income ratio requirements 45%. So it's pretty
Kind of
unique.
standard guidelines as far as that goes.
Standard guidelines. Rates are going to be in like the low sixes, depending. And then so essentially how it works is you'll get the down payment assistance, so it'll help you buy the home, and then it's a shared appreciation or shared equity program. So when you go to either sell or refinance, you'll pay back that original down payment. So, if you bought a $500,000 house, $100,000 was your down payment. So you'll pay that back. And then any appreciation gained, you will split with this program or with the
Interesting.
state of California.
So I thought it was going to be a little more juicy than that when
Yeah.
I first heard about it.
Yeah.
Because not only do you have to repay it, which in some cases with these government programs, these loans just disappear, right? As long as you own the home and live in it for a certain amount of time, you never have to repay it. But in this case, you do.
Right.
And on top of that, there's an equity share portion.
Correct.
Right?
Yeah.
And so is that kind of to make up for the fact that it's going to be applicable towards more people, or
Yeah, I think so. New program. I think it's launching today.
It's brand new.
Launching
Man.
today. So people
get the word out.
Get the word out.
First timers, if you don't have 100K
let's go.
stashed up,
let's go.
Yeah.
So yeah, I think it's part of that. One of the things, reading the, kind of the bulletin, the guidelines of this program is the money then will, like the shared appreciation, will go back towards the fund to help future home buyers.
Keep it going.
I think the first round, it's like 300 million that they're giving out. So, depending on the average assistance amount, that's maybe enough for like 2,000 or 2,200 people or families to use this program the first go around. So that's kind of going back to that to help out in the next round of funding. So yeah, it's an interesting program. It's got got some pros, got some cons. And it'll definitely, not everyone's gonna, want to jump on this program, but for those people who are, if they're looking at, hey, I really want to buy in the next 5 years, but like I just don't have the funds for, down payment or whatever it is, I think this can be a good program for them.
Yeah. Yeah. And as we know, waiting to get that down payment stashed up is often the biggest like difficulty for most people, especially first timers.
Right.
So if you can
Yep.
bypass that and get in, even if you're not going to walk away with as much as if you would have saved it up, but you also would be able to do it maybe a decade earlier in
Right.
some
Yep.
cases.
Yep.
Right. And we know that even as we are probably headed for recession and we have difficulty on the horizon, in most cases, housing markets actually thrive in recessions. Rates come down in recessions as
Yep.
inflation comes down. So will interest rates. So all of these things are going to be piled up on top of the fact that we already have an existing shortage of inventory. So people are going to be better off by taking advantage of that saved time, getting in sooner, seeing the equity accrue, and then make that next move when the time is right.